Imagine launching the #1 mobile game in the country, right? You're deploying these AI hosts that are objectively outperforming human streamers by like 80%.
Right.
You're beating Wall Street's top-line revenue estimates. And then after all that, you just sit back and watch your stock plummet 9% on massive volume in a single trading session.
Yeah, it's brutal.
It's wild. Welcome to Talk Tickers. Today we are unpacking the ultimate paradox of HUYA's Q4 2025 and full year 2025 earnings.
And there's a lot to unpack here.
There really is. I mean, you are looking at a company that is successfully ripping out its own legacy DNA. They're pivoting from a stagnant live streaming platform into this high-octane game-related services powerhouse.
Well, they're trying to, at least.
Right, trying to. And they have the soaring app store charts to prove it. They have legendary esports returns, some of the most compelling AI integration we've seen in consumer tech lately. The strategic narrative they're pushing is aggressively bullish.
It is, but, and this is a big but, the cash flow statement is screaming something entirely different. And that's exactly why we need to tear these numbers apart for you today. You have this incredibly optimistic operational pivot happening on the surface. But when you strip away the management commentary and, actually look at the quality of earnings.
The actual cash.
Exactly. The negative operating cash flow, plus some very questionable accounting provisions, a much more cautious reality takes hold.
Yeah, the market just isn't buying the top-line narrative anymore, are they?
No, not at all. Investors are demanding actual clean cash generation. And right now,
yeah,
the company just isn't delivering it.
So let's hit the raw numbers first, because I feel like this snapshot tells that dual story perfectly.
Yeah, lay it out.
It's a top-line triumph that's basically masking a bottom-line miss. So for Q4, revenue came in at RMB 1.74 billion, which is roughly US $248.6 million.
Right.
That is a 16.2% year-over-year growth rate. They actually beat consensus estimates by roughly $8 million. I mean, it's the highest revenue they've posted in the last 10 quarters.
Which it sounds great on paper. Yeah.
It does, until you scroll down to the bottom line. Q4 non-GAAP EPS showed a loss per ADS of RMB 0.84 or 1 US cent.
Meaning they missed the street's consensus by 3 cents.
Yep. And if you look at the unadjusted GAAP EPS, it was an even steeper loss of RMB 0.51 or 7 US cents.
And, the market's reality check on this was just swift and brutal.
Oh, absolutely.
These earnings dropped pre-market on March 17, 2026. Shares initially slipped, like 4.6% in early trading. And if management hoped the earnings call would stabilize things...
Spoiler alert, they were dead wrong.
Yeah, they were. The selling pressure accelerated throughout the regular session. The stock closed at US $3.15, which is an 8.96% drop on the day.
Wow.
But the price action is really only half the story here. Look at the volume. They traded 4.73 million shares.
Which is what, almost 3 times normal?
Exactly, nearly 3 times their normal daily average.
Yeah.
When you see volume spike to 3x on a 9% down day immediately following a top-line beat, that's not retail panic.
Right, that's the big money moving.
That is institutional capital aggressively unwinding positions.
Yeah.
They looked past the revenue beat, zeroed in on the margin degradation and the cash flow bleed, and just decided to get out.
You know what it's like. It's like a major retailer bragging about record-breaking foot traffic on Black Friday, right? They're showing off these lines wrapping around the building.
Yeah, taking photos of the crowd.
Exactly. But then having to admit to their shareholders that the cash registers were broken all day.
That's a perfect analogy.
You have all this incredible user activity, all this engagement, but it simply isn't translating into clean bottom-line profit.
No, it's not. And to understand why those cash registers are jamming, we have to look at the revenue mix shift.
Let's do it.
The legacy business, the live streaming tipping model that basically built this company, is effectively flatlining. Live streaming brought in RMB 1.146 billion in Q4.
Which is up, a negligible 1.9% year over year.
Yeah, barely a rounding error. Management pointed out this tiny bump came from higher average spending per user, but the actual domestic paying user base didn't grow at all.
It's stuck.
Completely stagnant at 4.4 million.
And you're hitting on the exact catalyst for their entire corporate pivot right there. I mean, the macroeconomic environment in China is soft. Discretionary consumer spending is really tight right now.
Very tight.
And the monetization landscape for those legacy tipping models has just permanently shifted. The days of a handful of wealthy users dropping tens of thousands of dollars a night in virtual gifts on their favorite streamers.
Those days are largely over.
Yeah, they're over. It's heavily restricted by tighter regulations and shifting consumer habits now. The live streaming well is drying up. They had to find a new engine or face a slow, grinding decline.
Right, and that new engine is their game-related services, advertising, and other revenue segment.
Wise.
And financially, it's on a completely different trajectory.
The numbers are pretty wild.
They are. This segment hit RMB 592.5 million in the quarter, which is an explosive 59.4% year-over-year increase.
Huge jump.
And more importantly, this segment now accounts for over 30% of their total revenue for the second consecutive quarter.
Meaning it's actually sticking.
Exactly. They've crossed the threshold where this is no longer just a side project. It's a core pillar of the business.
And let's be real, the absolute crown jewel of that new pillar, the ultimate proof of concept for this entire strategic pivot, is Goose Goose Duck.
Oh, absolutely.
They took the mobile version of this game, co-published it with Kingsoft Shiyu, and launched it in mainland China in January 2026. And the metrics are just mind-blowing.
Walk us through them.
Okay, so 5 million registrations in the first 24 hours. 10 million registrations in 6 days. It sat at #1 on the iOS free games chart in China for the vast majority of the past 2 months.
That's incredible.
It isn't just a successful launch, it's a cultural phenomenon.
It really is.
Yeah.
But as investors, we need to dissect how they manufacture that phenomenon, because it proves their value as a publisher, not just a broadcaster.
Right, the mechanics behind the hype.
Think about traditional user acquisition in mobile gaming today. It's a brutal, low-margin grind. Publishers dump millions into performance marketing, buying ads on social networks, just trying to force app installs with a heavy cost per install.
Yeah, and usually results in high churn and a terrible return on ad spend.
Exactly. What they executed with Goose Goose Duck is fundamentally different. They deployed a content-driven publishing strategy, leveraging the marketing flywheel of their existing streamer ecosystem.
Right, they didn't just run banner ads, they turned the launch into a localized entertainment event.
Exactly. Well, before the game even dropped, they produced 2 entire seasons of a live streaming variety show called Goose Goose Night.
I saw some of those clips.
Yeah, they took their top-tier exclusive streamers, the ones with massive built-in audiences, and had them play the PC version, creating this high-stakes, highly entertaining social deduction content.
So they essentially manufactured virality.
Yes. By coordinating these streamers, they created over 100 organic trending moments that spilled over onto platforms like Douyin and Xiaohongshu.
I want to pause on that for a second because manipulating the algorithm on platforms like Douyin, which is basically the Chinese equivalent of TikTok, isn't just about posting clips.
No, it's highly technical.
Right. It requires a highly coordinated hashtag strategy, utilizing stitch features, and getting key opinion leaders, or KOLs, to do reaction videos simultaneously.
Yeah, a synchronized attack.
They essentially hijacked the recommendation algorithm by flooding it with high engagement, localized moments from Goose Goose Night. They didn't buy those 10 million users. They organically cultured them through parasocial relationships with the streamers.
And that is the competitive advantage right there. They utilize their sunk costs, the expensive contracts they already hold with these top streamers, to act as a zero marginal cost user acquisition funnel for a game they co-publish.
It's brilliant operational synergy, I'll give them that.
It really is.
Okay, I hear the synergy argument, but I have to play devil's advocate here for a second.
Go for it.
As an investor looking at the income statement, I'm seeing 10 million users in 6 days. I'm seeing the #1 iOS game in the biggest mobile market in the world.
Right.
So where is the cash? If they have the undisputed heavyweight champion of the App Store right now, why isn't there a massive, undeniable revenue spike dropping straight to the bottom line this quarter?
That's the billion-dollar question. And the answer is because they haven't turned the monetization dials yet.
Really? Just holding back?
Yeah, and this is a deliberate, albeit risky, management decision. Right now, they are aggressively prioritizing daily active user growth and long-term retention over immediate cash extraction.
Playing the long game.
Exactly. Look at the demographic data. The player base for Goose Goose Duck skews heavily toward college students and young working professionals.
Okay.
It has a notably high proportion of iOS users and female gamers. In the Chinese market, this is an incredibly valuable, high LTV lifetime value demographic.
But they're finicky, right?
Extremely. They are notoriously sensitive to aggressive, early pay-to-win monetization tactics. If you hit them with heavy gotcha mechanics or expensive cosmetics in week 1, they churn out and move to the next trend.
So it's a delayed gratification play. They're letting the player base get deeply entrenched, building out the social graphs and just waiting.
Precisely.
Yeah.
Management specifically noted they are withholding the heavy monetization events until the summer.
Ah, okay.
Yeah, they're planning to introduce new party game modes and highly customizable home systems. And those are features that naturally lend themselves to cosmetic, high-margin microtransactions.
Oh, yeah, virtual furniture is a gold mine.
It is. They want the user-generated content ecosystem fully established so that when they finally introduce those premium skins or home decorations, the players are already too invested in their digital social standing to opt out.
It's the classic strategy, right? Building an incredibly wide, deep moat before you even think about constructing the toll booth.
That's a great way to put it.
If they can flip that switch successfully this summer, the operating leverage could be massive. But Goose Duck is just one piece of the puzzle here.
Right, there's more.
Let's look at the second major operational pillar of this new growth engine, in-game item sales. This specific subsegment saw greater than 200% year-over-year growth.
Massive.
And the catalyst here wasn't a new game, but a specific event within an existing behemoth, Honor of Kings.
Right, and for context for anyone who might not know, Honor of Kings isn't just a game in China. It is a foundational piece of the digital culture there.
It's like a national pastime.
Truly.
Yeah.
So securing exclusive pre-sale rights for a highly anticipated cosmetic item in that specific title is a massive coup.
They secured the exclusive pre-sale rights for the FMVP skin, and the transaction velocity was staggering. I mean, they generated nearly 10 million RMB in gross billings in just the first hour of that launch.
In an hour.
10 million RMB in 60 minutes.
What that 10 million RMB figure proves is the sheer conversion power of their platform when paired with tier 1 intellectual property.
Yeah, it's undeniable.
When you have an audience already conditioned to spend money digitally through years of the live streaming tipping model, and you pivot them toward high-demand digital goods, the friction to purchase is practically zero.
They're already used to entering their credit card info.
Exactly. And importantly, they aren't restricting this playbook to just the domestic market. They are actively applying this strategy internationally.
Oh, really? Where else?
They partnered with games like Arena Breakout to launch customized exclusive bundles targeted specifically at overseas players.
Okay, so expanding the footprint.
Yeah, this is a critical proof point for developers. The platform isn't just a place to buy banner ads. It functions as a highly targeted, high-conversion digital storefront that can drive immediate global sales.
And all of this publishing and digital storefront activity is built on top of their continued dominance in esports, right? They aren't backing away from competitive gaming. They are essentially institutionalizing it.
They really are.
In Q4 alone, they hosted close to 100 licensed tournaments and produced around 40 of their own self-produced tournaments and variety shows. But the real strategic milestone was the 2025 Damasha Cup in December.
The Damasha Cup is huge because it represents a structural shift in their relationship with game developers.
Oh, so?
This was the first time the official league granted hosting rights to a third-party streaming platform. Previously, they were merely passive broadcasting partners, right? Paying exorbitant licensing fees just for the right to restream a feed.
So they were basically just a TV channel.
Exactly.
Oh.
But now they are acting as the full-service tournament organizer. They control the production, the sponsorships, the localized broadcasting, and the entirety of the localized monetization. They are capturing significantly more of the value chain.
Add to that the return of Uzi to the platform in February 2026.
Oh, man.
For anyone outside the esports bubble, Uzi returning to stream is like Michael Jordan coming out of retirement to play for your franchise.
It's a massive, massive deal.
It's a huge validation of their ecosystem's gravitational pull. But as much as I love the esports narrative and the publishing wins, we have to talk about the technological shift happening under the hood.
Let's get into the AI.
The AI integration here isn't a gimmick. It is a deep, structural evolution of the business model. Management reported that AI-powered channels now contribute nearly 10% of total daily active users.
I really want to emphasize how highly unusual that metric is. Having 10% of your DAU actively interacting with AI-generated content isn't a novelty feature. It indicates a fundamental shift in user behavior and platform architecture.
The performance stats they released on these AI hosts are almost hard to believe. We're talking about AI entities equipped with incredibly realistic 3D avatars, providing professional-level gaming commentary and interacting with the live chat in real time.
And doing it flawlessly.
And they are outperforming real-life human peers by 40% in terms of viewing time and retention.
Which is crazy on its own.
And it gets crazier. The top-tier AI channels, they're outperforming human streamers by 80%. 80%.
I know, it sounds insane, but when you understand the underlying technology, the 80% outperformance makes perfect sense.
Break it down for me.
Think about the LLM, the large language model pipeline, required to run this. The AI is simultaneously running speech to text on thousands of chat messages, conducting real-time sentiment analysis on the crowd's mood, formulating a text-to-speech response, and rendering the micro-expressions on a 3D avatar without latency.
All at the exact same time?
Exactly. A human streamer can only read one chat message at a time. An AI can theoretically address 500 viewers by name in the chat log while verbally answering a question on stream.
Wow.
Furthermore, a human gets fatigued, right? They get tilted by trolls, their energy flags after 4 hours. The AI operates 2047 at peak algorithmic optimization.
It's like having a tireless digital workforce that knows exactly what the audience wants, never demands a vacation, and most importantly, doesn't require a 50-50 revenue split.
That's the real kicker.
The margin implications here are extraordinary. With traditional top-tier streamers, the platform is basically held hostage. You pay massive signing bonuses, you give up huge chunks of the tipping revenue, and you carry all the platform risk.
Yeah, if the streamer burns out, gets into a contract dispute, or has a public behavioral issue, your revenue takes a hit.
The AI host eliminates all of that friction.
They're also pushing this multimodal AI directly into the gameplay experience itself, bridging the gap between viewing and playing.
Right, the new tool.
Yeah, in March, they launched a proprietary map tool for the game Delta Force. It features context-aware AI that provides real-time navigation and immersive 3D environmental assistance to players while they're in-game.
So it's basically a co-pilot.
It's not just a chatbot, it's a dynamic digital companion analyzing the game state in real time.
Okay, so if the AI is slashing content costs and the game publishing wing is printing high-margin item sales, why is the stock down 9%?
Here we go.
This brings us to the profitability paradox. The narrative sounds flawless, but the financials are a mess. Let's unpack the quality of earnings, because at first glance, the margins actually look like they are improving.
They do.
Gross margins expanded from 11.4% a year ago to 14.1% in Q4. That's a 270 basis point expansion directly driven by the higher margin advertising and those in-game item sales.
Gross margin is improving, yes.
Yeah.
But below the gross profit line, the quality of earnings deteriorates rapidly, and this is exactly where the institutional investors hit the sell button.
The red flag.
You have two massive, highly concerning one-off red flags that management tried to brush off, but the market unequivocally rejected. First, they recorded an RMB 66 million receivable provision within their general and administrative expenses.
Okay, let's pause and break down the mechanics of why an RMB 66 million receivable provision is such a glaring red flag for an experienced investor. This isn't just a typo on a spreadsheet.
No, not at all. When a company books a receivable provision, they're basically admitting a past failure in revenue recognition. They previously recognized that RMB 66 million as revenue, booked it as an asset on the balance sheet, told investors they expected to collect that cash, and are now, years later, admitting they will likely never see a dime of it.
Ouch.
In this specific instance, management disclosed this originated from a 2021 arrangement with a broadcaster. They deemed it to have a, quote, heightened risk of non-recoverability.
Think about the context of 2021. That was the absolute peak of the streaming wars. Platforms were throwing exorbitant minimum guarantees at talent agencies to secure exclusive broadcasting rights.
Handing out cash like candy.
Right. What this provision likely means is that an agency breached a contract or failed to hit deliverables 4 years ago. The platforms stubbornly kept that RMB 66 million on the books, assuming they'd win an arbitration or claw the money back somehow.
And now in 2026, they're quietly throwing in the towel and taking the hit on the income statement.
It speaks to poor capital allocation in the past, and it honestly makes you wonder what other skeletons are hiding in the receivables.
And that wasn't the only skeleton they dragged out this quarter. They also detailed an RMB 81 million investment impairment in Q4.
Another one.
Yeah. They attributed this to the weak financial performance of certain companies they'd previously invested in. So when you combine the receivable provision and the investment impairment, you have nearly RMB 147 million in unexpected, non-operating hits to the bottom line in a single 90-day period.
But the number that truly broke the market's back, the metric that likely triggered the 2.9x average daily volume sell-off, is the cash flow reality.
It's grim.
For the full year 2025, operating cash flow swung to a negative RMB 176.2 million. Just compare that to the prior year. In 2024, Operating cash flow was a positive RMB 94.3 million.
That is a devastating deterioration in the actual cash generation of the underlying business.
Now, management was incredibly aggressive on the earnings call trying to defend this, right?
Why they tried their best.
They framed both the 66 million receivable provision and the 81 million investment impairment strictly as non-cash accounting adjustments. They pointed out that if you construct a non-GAAP metric excluding those impairments, alongside share-based compensation and amortization, their core operating profit has actually grown for 3 consecutive quarters.
So they tried to paint a picture of a business that is fundamentally profitable if you just ignored the historical write-downs.
But if it's genuinely just a non-cash accounting adjustment, clearing the decks for a brighter future, why did the market punish them so harshly? Wall Street usually loves a kitchen sink quarter where a company writes off all its bad debt at once.
Usually, yes.
Why drop the stock 9% on massive volume if the core operating profit is actually growing?
Because the market is suffering from severe adjustment fatigue.
Yeah.
Institutional investors are not stupid.
Right.
When a management team repeatedly asks you to ignore multi-million-dollar write-downs because they are non-core or non-cash, you start to question the underlying rigor of their entire financial apparatus.
You lose trust.
Exactly. The market is demanding clean, unadjusted earnings and actual, tangible cash generation, not a better strategic narrative. You can boast about 10 million Goose Duck users and 80% better AI retention all day long, but when your operating cash flow goes from positive 94 million to negative 176 million, investors stop trusting the adjusted non-GAAP metrics.
Right, because a receivable provision might be classified as a non-cash charge today, but it represents actual cash that should have flowed into the business in the past and didn't.
Exactly.
It is a fundamental failure of working capital conversion. The narrative is pointing straight up to the moon, but the actual cash register is literally going backward.
Let's broaden the lens a bit and look at the macro investor context, because this company does not operate in a vacuum.
Right, the broader China picture.
Management explicitly cited the soft macroeconomic and monetization environment in China. Discretionary income is under pressure, and that directly impacts their legacy live streaming operations. And you can see this macro pressure reflected in the drastic relative underperformance of the stock leading up to the print.
The relative performance is ugly. In the month leading up to this earnings call, from mid-February to mid-March 2026, the stock plummeted 26.2%, falling from $4.27 down to $3.15.
It's a cliff.
Now, you might say, well, Chinese equities have been volatile, but compare that to the broader sector. Look at the KWEB ETF, the Crane Shares CSI China Internet ETF, which holds the biggest tech names in the region.
Let's hear it.
KWB only dropped 7.0% in that exact same 30-day period. A 26% drop versus a 7% drop is massive relative weakness. Over a full one-year time frame, the stock is down 15.1%. Capital has been bleeding out of this name for a while.
Which is exactly why management is leaning so heavily into capital return programs. They're trying to placate frustrated shareholders and buy themselves enough time to execute this operational pivot.
Buying time.
And to their credit, they have a massive liquidity buffer to support this strategy. At year-end, they reported RMB 3.82 billion on the balance sheet.
That's a solid chunk of change.
That's roughly US $546 million in cash, cash equivalents, and deposits. They're not going bankrupt tomorrow.
And they are putting that war chest to use. The board approved a 2026 special cash dividend of US 0.135 cents per ADS.
Nice little yield.
That totals about $31 million leaving the balance sheet, payable around June 30th. Furthermore, under their existing $100 million share repurchase program, they have already bought back 22.9 million ADSs for US $75.5 million.
So they are aggressively trying to establish a floor on the stock price.
So the core debate for you, the investor, is incredibly stark right now. It's a tug of war between two entirely different ways of valuing a business.
Very true.
On one side, the bulls are entirely focused on the durable operating leverage promised by this transition. They see the 59% growth in game-related services. They see the Goose Goose Duck monetization catalyst coming this summer.
The upside.
Right. They see an AI infrastructure that could drastically slash content acquisition costs while simultaneously boosting engagement. The bulls see a company returning capital via buybacks and dividends while successfully executing a necessary pivot.
But on the other side, the bears are entirely focused on the balance sheet and the cash flow statement. They see negative cash conversion.
And the write-offs.
Exactly. They see a history of aggressive revenue recognition leading to sizable receivable write-offs years later. They fear further investment impairments hiding in that portfolio.
It's a valid fear.
The bears believe the legacy tipping model is in terminal secular decline, and the new game-related revenues, while growing rapidly, are not yet generating the clean, predictable cash flow necessary to justify a higher valuation multiple.
It is a classic standoff, future strategic promise versus current financial quality.
The bulls are buying the narrative, the bears are selling the cash flow.
All right, that brings us to the close of our fundamental analysis. We've unpacked the pivot, we've dissected the margins, and we've outlined the core debate dividing the market. Now we transition to our final segment.
The fun part.
And as always, we must state firmly, this is not financial advice. This is the part of the show where we put on our hedge fund PM hats and pitch an outrageous but plausible trade idea based strictly on the mechanics we've uncovered today.
All right, let's hear the pitch. What's the play?
I call this the B2B AI infrastructure spin-off play.
Okay, I like the name.
And the logic here is hidden in plain sight within those AI metrics we discussed earlier. The trade is this. You go long on this company's long-dated, out-of-the-money call options.
Okay.
Simultaneously, you initiate aggressive short positions against legacy influencer management agencies globally, the companies that represent human streaming talent.
Wait, shorting human talent agencies to go long on Chinese AI streaming avatars? Walk me through the mechanics of why that works.
Hear me out. The thesis relies on the inevitability of margin optimization. Their proprietary AI streaming avatars are already outperforming human hosts by 40% to 80% in retention and viewing time. Their multimodal AI real-time navigation tools are being integrated directly into game clients like Delta Force. That technology, the LLMs, the real-time sentiment analysis, the 3D rendering, is simply too valuable and way too scalable to keep captive on a single, low-margin B2C streaming platform facing a soft domestic macro environment.
Oh, I see where you're going with this. The trade assumes that management will eventually have an epiphany.
Exactly.
They'll realize their highest margin future isn't in fighting a grueling, localized war for consumer eyeballs in China, but in licensing this entire AI tech stack as a B2B SaaS product globally.
Exactly. Think about the total addressable market here. Imagine them licensing these AI avatar engines and real-time interactive models via API to Western platforms like Twitch, YouTube, or directly to massive global game publishers like EA or Take-Two.
That'll be massive.
They effectively transform from a struggling B2C streaming aggregator into the high-margin AWS of esports infrastructure. If they do that, the legacy human talent agencies, the bloated middlemen relying on taking a 20% cut of temperamental, easily fatigued human streamers, are suddenly competing against infinitely scalable, perfectly optimized, zero-drama digital talent.
Makes sense.
You are going long on the ruthless infrastructure of the future and shorting the inefficient, human-reliant middlemen of the past.
It's an incredibly aggressive, highly speculative thesis, but I'll admit it perfectly captures the hidden optionality within their R&D spend.
Right.
If those AI engagement numbers hold at scale, keeping that technology internal to just service 4.4 million stagnant domestic users is a massive misallocation of a potentially globally disruptive asset.
Well, that wraps our Pulse analysis for today. To recap, we're looking at a company successfully executing a highly complex operational pivot into game publishing and AI infrastructure.
But one that is currently shadowed by murky financial quality, legacy write-downs, and negative operating cash flow.
Exactly. The strategic storyline is compelling, but the market is demanding cleaner accounting. As always, we urge you to review the SEC filings and the raw data yourself before making any investment decisions.
Yeah, the transition from a legacy business model to a new technological paradigm is rarely a smooth upward line on a chart. It's messy, it requires heavy capital expenditure, and it requires intense investor patience.
The numbers are on the table, the strategy is in motion, and the cash register is waiting to see if all that Black Friday foot traffic actually pays off.
Time will tell.
The question you have to ask yourself is, when that summer update drops for Goose Goose Duck and the AI hosts start taking over the primetime slots, will you be focused on the top line growth or the bottom line cash? We'll see you next earnings cycle.